Well, I'm absolutely delighted to welcome today's guest. We have Ray Drew, a six times top producing SBA Business Development Officer and the host of the leading podcast, The Art of SBA Lending. Ray has dedicated his entire professional career to helping small business owners and acquisition entrepreneurs build their empires by navigating the intricacies of borrowing from the US Small Business Administration. Welcome, Ray.
Thank you for having me.
Really looking forward to this because one of the questions we get at the summit all the time is how do you fund your deals? And as a UK citizen looking over at you guys in the US, the SBA just looks like an incredible facility. So dying to get into this. But before we do, who is Ray Drew? How did you end up where you are? Talk us a bit through your journey.
Yeah, I mean, I'm an SBA lender, and I was lucky enough to get into my industry right out of college. So I jumped in. I was 21, 22. Started as just a salesperson, pounding the phones, trying to call a hundred commercial real estate brokers a day, and trying to get them to use us for financing type of thing, which definitely thickens your skin and sets a nice foundation for a career. So I was grateful to be able to have that opportunity, and ultimately that parlayed into my career as an SBA 7A lender, is what I've been doing the past little over a decade. Um, I have been at a few different institutions. I've typically always worked within the institution, meaning like the direct lender, whether it's a bank, credit union, or non-bank lender. There was a brief period here recently where I was on the outside as an advisor while I was kind of in between shops, which was an interesting experience. We could talk about that more later. But this is what I do. I eat, sleep, and breathe SBA, and it's quite frankly, it's my only skill in life. Thankfully, I like it a lot, so it's been fun.
I'm sure that's not true. I bet you have more than one skill.
You'd be surprised.
What's the difference? You mentioned there the SBA can be from a bank, a credit union, or a non-bank entity. Is it the same process always, or are there variations between those entities?
It's a little bit different. There's some things are the same, some things are different, like anything. I mean, I personally have been dodging the FDIC for years. So I work at a credit union now, and FDIC that regulates our banking, industry here in the United States. So I'm at a credit union now. So our SBA group is a division of Truliant Credit Union out of North Carolina, and we're a nationwide SBA 7A lender. Before that, the last 9 years I spent at non-bank lenders. That was a little bit different. Mainly your funding source, where you're getting your money from is different at, a non-bank lender. But the vast majority have been at our banks that provide this product. And I like to be a little different. So I have been outside of the banking world and non-bank lender land and now credit union land for the past 10 years. But ultimately, what the program is like the SBA going to these institutions and saying, hey, we want to get access to capital out there to create and retain as many jobs as possible in the United States. So you're saying no to all these deals for various reasons, whether it's the business is too new or there's not enough collateral, you don't have enough experience. We're willing to absorb 75% in most cases of the losses if a deal goes bad. Now, all of a sudden, we can do deals that we couldn't otherwise do and offer terms that we wouldn't have otherwise offered. And so all the banks, are like, actually, it's not all the banks. Probably about 25% of the banks in our country have made at least one SBA loan in the past year or so. So it's actually not it's a minority of the banks that are participating in this program, but that's mostly having to do with just how complicated it is to set up and navigate. But that's why it's important to work with like an expert sort of shop that has that dedicated SBA experience. So some parts are different, some parts are the same. But right now I'm going into this credit union and helping build up their department, and it's very similar to what I was doing at the non-bank.
Okay. And is the criteria always the same? So if you went to a bank or L went to a non-bank, would the answer always be the same, either, yes or no?
So in like about half of the stuff that matters to small business owners, it is going to be the same. On a business acquisition, you're going to finance it over 10 years. There's not going to be a prepayment penalty. That's going to be the same no matter what. But this other half, the SBA gives the lender some wiggle room. So how much money do you need to put down? Well, the SBA does have a minimum equity injection requirement, minimum down payment of 10% on a business acquisition. Um, some banks might want more, right? So that's where it starts getting a little bit different. Some banks may allow seller financing as part of the injection. Some may not be comfortable with that. And the SBA has been gravitating more towards that, having the lenders really decide what they want to do, versus them telling all the lenders what to do. In the sweeping changes they rolled out last year, they essentially, the theme of it was do what you do. So they literally took out many of the guidelines that used to be in black and white and said, hey, whatever you guys want to do, you do. So the marketplace for SBA has been more, diverse, but also chaotic than ever. Because if you're a small business owner coming to this market for the first time, you're like, well, am I gonna have to talk to 100 banks and figure out what's what? And it try to figure out the best thing for me. And that, I mean, kind of, yeah. I mean, you want to talk to as many options as possible, and you are going to get different answers from different folks.
Right. Okay. Yeah, that's really interesting. What are the do you know what the success and failure rates are of SBA loans? Because obviously there is that level of protection, 75% from the government. How
Yeah.
many don't work?
Well, I will tell you the answer. I do know the answer, but it's also, I feel like it's like a trap in a way, because we've been operating for, think about '08. This is where I kind of come in. '08 was like the worst financial disaster of our lifetimes. And coming out of '09, 10, 11, 12, I mean, it was tough for small business because remember, all the big banks got the bailouts. With COVID this time, Main Street got the bailouts, which was kind of cool, PPP and EIDL. But back then, it was big banks getting bailed out, and small business was really suffering. And it was a slow and steady climb out of that. And um, the oh, I just had a total brain fart. Um, what
Slow,
was the
slow,
question?
a slow, steady climb out of the recession.
But I was giving you probably the way too long-winded of an answer to something, and I got way sidetracked.
What
What
are
was
the
your question?
what are the failure rates, or I guess what are
Okay,
the
so it
six?
was 1%. There's a quick answer. So coming out of there, remember the Fed dropped the rates to zero. And so we were operating that zero interest rate environment for, first of all, 6 years straight from '09 to 15, rates were zero. So if you got an SBA loan, you're paying 4, 5, 6%. That is dirt cheap money at that time. And only in 16, 17, 18, 19 were the rates sort of inching up. But even when COVID came and they brought the rates back down to zero, the rates still were really low. It was prime was so all the SBA loans are based on prime, the interest rate Wall Street Journal prime, the index. And when rates are zero, what that means is prime is 3.25. So when COVID came, I think prime was about 4.75. So only a point and a half above zero. And that was when the economy was red hot. So during that whole time frame, you know, obviously '09 was, you had double digit losses in the program, but coming out of there, 15, 16, 17, 18, it's 1% default rates, right? During COVID, and we flooded the markets with so much liquidity, and we were literally, the SBA was making your payments for you. Like when COVID hit, if you had an SBA loan, SBA was literally writing the check to your lender for, first of all, like it was like April through September, and then there was more, and then there was more, and then Biden came in and there was more. So Yeah, there not a lot of people are going to default when money's falling from the trees, but all of a sudden things get a little tougher. Now you see the default rates increase by 40%. Now, when you say increase by 40%, that sounds bad, but when it was 1.5 and now it's 2.2,
Mm.
that's where we are. That's where we're sitting today in low 2% for default rates.
Yeah, which is really low. It's incredible.
Yeah.
And is that due to the criteria to get them, I guess? They don't just give them out to anyone. You've got to have a really robust, brilliant business.
I think it first of all, yeah, you are getting underwritten heavily. It's a global type of underwriting. We're understanding the business, we're understanding who owns the business. If you own 20% or more, you're personally guaranteeing the loan. If you have a house with equity, you may even be pledging your house as collateral. So you're all in. That helps lower the default rates, but also we're going to do cash flow analysis. We're going to go pretty deep in the underwriting, spend about 2 weeks, having my underwriter come in and just try to poke holes where they can and see if this is like a sound transaction of finance. But that's one reason. The external, like in '08, we underwrote all those deals, but yet the default rates went above 10% because of the economy. I don't think
Mm.
we're headed there, but I do think that if you come in and get an SBA loan today, um, to think it's, hey, we have a 1 or 2% chance of this going bad, I think those numbers are artificially low because of the things I mentioned before, having to do with the rates and the extra liquidity in the market. This is a tough game. And if we're trending in a higher default range. So I don't know where it stops. But it's just, we've been kind of for the past 15, really since I've been doing this, like what, 13 years, um, that's the cycle we've been in. So it's always changing. So I just caution people not to say this is no risk or low risk. There is a lot of risk when it comes to small business ownership, and putting 90% leverage on an acquisition that you're paying a 4x multiple on, there's risk to that.
Mhm. Yeah. Have any of yours personally defaulted?
Yeah. Yeah. I mean, if these go bad, typically what's happening, so first of all, why does a deal go bad? That's right off the bat, people want to know that answer. The biggest thing you're seeing is just fraud, seller fraud, misrepresentations. The second thing is lack of due diligence. So sometimes when you're buying a business, like you just can't diligence everything. There's always going to be a gap between your diligence and what it really is. And it's just a matter of how material that gap is going to be. And so on some of the deals, that is an important gap. Like I remember something that randomly just came into my head was somebody bought a business in an industry they don't know anything about, which is not abnormal. But you're a strong manager, you're a strong entrepreneur, and you want to buy a business that's creating great cash flow. It has all the good characteristics, recurring revenue, contract revenue, whatever, no concentration issues. And, in this particular case, there's just there was some regulation that was coming down the pike that the seller knew about, that the buyer didn't know about, that it adversely impacted the business. Now you have a problem. So when sellers are selling, grilling them about why they're selling is really important. All of the sims that I read say retirement, pursue other interests, but there's always a deeper reason, right, behind why you're selling your baby, your business. And the ideal situation is retirement. Like, hey, I've been running this for 30 years. I'm 67. I need to retire. Those are great. But then you also have some instances where they've owned it for 5 years or 10 years and they're 50 and they're wanting to sell. And you really got to ask yourself the question, why are they selling?
Yeah, I love that. It's a really, really powerful question as well, because you're right. Everyone always says, oh, yeah, I'm retiring. I'm going to go and buy a boat and go and sail off into the distance. But there may be something, yeah, as you say, regulatory coming down the road. We've done 15 acquisitions to date here in the UK, and twice things have come out which didn't come up in the due diligence that, to be fair, we would probably never have found in due diligence if we'd have done it for 1,000 years. So it definitely happens. Um, Before we get into some of the sort of specific questions that have come over from the audience, if we sort of zoom back out for a moment, if someone isn't familiar with the SBA, I imagine most of the guys who are watching this in the US are. Everyone in the rest of the world might be going, "What is this?" So when should someone explore it? What makes it powerful? And when would you say the SBA isn't right?
So the thing with the SBA program, the 7A particularly, which is the flagship program, it, it's about 27 billion is how many approvals we had last fiscal year. Our fiscal years go through September, so those numbers are a little old now, 9 months old, but um, that is a big program. That's 50,000 plus businesses in our country, and you can use this program for so many different things. The change of ownership transactions, as we call them, these are your business acquisitions, partner buyouts, and also are included in there. That's about 20% of the pie. Um, you also have real estate. You have people coming in and buying a building for their business. You have people buying different types of unique properties like hotels, gas stations, and car washes. You also have people that are just trying to consolidate some debt that they took out because they needed some money and they want to try to now improve those terms. You have some people that want to expand organically and create a new division, and they need permanent working capital to hire some key employees and pay for marketing and things like that. You have the whole franchise world embedded in SBA. You want to open an Orange Theory Fitness or a Crumble Cookie. Most of these people are getting SBA loans. So you can do all of these different things. And the reason people are gravitating towards them is really three or four key things. One is the terms, the term, like the amortization is longer than your typical conventional. Like if you buy a business conventionally, you probably get 5 or 7 years. Well, with SBA, you get 10 years and there's no prepayment penalty. It's really friendly terms. The equity requirements are number two. I mean, I'm doing a deal right now where the buyer has built his own business, got it to 7 figures from scratch. He's been in the industry 8 years, but he started when he was young, 16. So he's like 24, 25 right now. We just approved a $4.8 million loan for him. He's buying a business that had, I just was looking at the numbers, 1.5 million EBITDA. And the debt between him and the seller, I'm sorry, the debt service between me, the SBA lender, and the seller is 850K a year. So, you're looking at excess cash flow of like 600K a year. He's
Mhm.
putting in $150,000 into this deal. Think
Wow.
about that cash on cash return. It's insane. So that equity can, you can, if you already own a business and you're trying to buy another business, if your existing business has equity, you may not need to put in the 10%, because we're going to view that as more of an expansion. But in any event, even if it's 10%, and you can raise equity for some of it, you can have the seller help you with some of it, you can put in all of it if you want. It's just a much lower admission to get in, the equity requirements. And then finally, it's the only game in town in many of the areas around here. To buy a business for 2, 3, 4, 5 million, even sometimes 6, 7, 8 million. I mean, SBA only goes up to 5 million, but this is kind of like no man's land. I mean, conventional lending is not very robust in this sector of the market. So it's kind of your only game in town outside of like cash and seller financing. And it's kind of the same way in startup franchise world. So you're just able to get stuff done that you wouldn't ordinarily be able to in conventional.
Yeah, so it's super powerful, really, really versatile to use it across so many different business entities, real estate, franchising, MBOs, LBOs. Wow, it's yeah, pretty powerful. You mentioned there you could, I think the ceiling was 5 million. Is that 5 million per business, per person? How does it work?
Well, it used to be per person, but now it's changed. And this is probably the most under the radar, mind blowing thing that occurred last year when the SBA rolled out these sweeping changes. I have not done one yet, but I can't wait to do one because for years, you would only be able to sign on to 5 million, right? So period. Like personally guaranteeing 5 million. But now, because of this one key change they made, you can theoretically get unlimited money. That's right. So the main things are essentially like if you're if you own a business, let's say it's an ice cream store and you want to buy a gas station and it's a different industry, your ice cream store business debt in SBA is not going to count against this new venture. Um, it goes by NAICS code, industry code, the 6-digit code here that we have. If the first 3 digits are different, then you're in a totally different sector. Then that's going to be new money. That's going to be you have a fresh 5 million to tap into. Same thing as if you own only 49% of the ice cream shop. You can actually go buy another ice cream shop where you own, 51%. And those are not going to be considered affiliated because you're not meeting a certain ownership percentage. So anyway, they opened up the rules um, last year to basically allow for more multiple $5 million loans. And it's funny because that actually spurred another debate here, which is, well, why is it a $5 million cap? If you can go and get unlimited money, why can't you get it for your business that you've been growing to keep growing? So, there's people in the industry that are working to try to lobby, to get our loan increased, which makes sense based on inflation, right?
Absolutely. And if you can go and get 5 million for 5 different businesses, as you say, why can't you get 25 for the same one?
Exactly.
How is that viewed? Because I know a lot of the lending here in the UK, you have to have industry knowledge. It tends to be the more sort of entrepreneurial lenders, the tier three lenders, they will invest in a person if they think you've got the skills necessary. But once you start going out of your industry, that becomes a little bit more difficult. So if you, how did the SBA view it if you're going into like 5 completely different sectors?
Well, I think that it is difficult. You don't see it too often. This is kind of new territory. I mean, we have grown this program based on the guy or gal who grew up in their trade or industry, went out on their own, started a business. These are baby boomers for the most part, and have borrowed money through the SBA programs. So they're coming up through the industry. You talk to a lot of them. They don't know what a balance sheet is supposed to look like. They don't know their numbers the way a bank's looking at the numbers. These are not investment banking, private equity people, but they know their business like the back of their hand. They do their own math to figure out that their margins need to be like this and that they know that they have money in the bank to pay payroll. And that's just how they think. You have this new generation of business buyers coming in that have the more financial background. Um, but they don't know, the industries that they're looking at. They know, they're just financial people.
Mhm.
Um, Even some people from tech and corporate America who just know how to operate in large organizations and maybe can bring some operational efficiencies to some of these businesses. Like they're looking for businesses as well. So to me, it's pick your poison. I can lend to someone that knows the industry. Hey, if the roof is leaking, I know my owner can go fix that roof. But does that mean I'm going to get paid in my loan payment? Like over here, I know these guys and gals know how to manage a P&L, how to manage a budget, how to manage, people, set up processes, whatever. Um, do they need to know how to turn the wrench? Does that actually add value to growing the business's enterprise value? There's definitely pluses and minuses to both. In a perfect world, you have both teaming up, but that's just not the case most of the time. So you can do business acquisition financing all day long with somebody coming in who has strong management experience. And ideally, they're buying a business in a field that they have some sort of tie to in a way. Like if it's just totally random and doesn't make sense, I mean, it kind of does get a little hard. Because you have to see yourself there in the business as the buyer. I mean, this is an operating business. It's a breathing, living thing. You gotta be there. So it's not, you're not just buying cash flow. It's not a real estate investment. So you gotta, it's all about finding the right match, but you don't need the direct industry experience on most of these deals.
Okay, that's really, really interesting. What would happen? So 5 million is your limit at the moment. Might change on the same sector. If there was a business and the business was for sale and the value was 7 million, can you use 5 million from the SBA and then another form of lending for the other or deferral?
So, well, we would often bridge the gap with seller financing. Like I did a deal last year that was an $8 million purchase. We did a loan of 5 million. The buyers brought 1 million, and the sellers, it was actually an e-commerce business, and they had a lot of inventory. So the seller actually financed the inventory on consignment. You could have also done a seller note, would have kind of helped bridge the gap as well. Once you start getting above that, you know, it starts getting a little tough. Theoretically, you can, but most of the time it's hard to find someone else to bridge that gap from a third party standpoint. Um, the seller is kind of who you're looking to help do that.
Yeah, that's interesting. I know some of the lenders in the UK, they wouldn't, if there's already a primary lender who's got a charge over it, they wouldn't then come in and add more lending or more debt into the deal.
Yeah, so the lender themselves could do that for sure. And there's probably about 5 or 7 lenders here that are players in the space that are doing that. I'm not one of them. Um, but it still gets a little tough because they're used to lending with that 75% guarantee. And all of a sudden, you're now extending that additional debt with no guarantee. So now that deal's got to be, ironclad,
Mm.
um, got to be much stronger. But it is at least it's an option that's there, which is cool. And you're seeing more and more lenders coming online with that. I mean, I'd love to get involved in that in the future. Right now, we're kind of getting our program set up. We came in here and there was a program in place, but they were very dependent on the on third party company that was processing. And so when I came here about 2 months ago, I brought a team with me of about 10 people that are underwriting experts, closing experts, loan coordinators. And so we're now building all that in house and really creating a solid foundation of our core lending program, which is those 7A loans, 500,000 to 5 million, and focus really in the business acquisition space. And then, once you get that kind of stabilized, you then start going into these other areas to kind of grow and expand. But we're not there yet.
That's to come. And you mentioned there the 7A is the main program, but recently there's an express version, I think I read. Is that right?
Well, there's an express loan. Express loans are not that popular because there's only a 50% guarantee. So in the SBA 7A world, it's kind of, there's 3 tranches. There's the 150 and under. If you do a 7A loan 150 and under, you actually get an 85% guarantee. So the SBA is trying to incentivize small dollar loans. That's been like a big focus of them for many years, getting those small dollar loans out the door. So that's a little incentive there. So there's a lot of lenders that are building their machines to handle those large quantities of small loans.
Mhm.
And then like 150 to 500, that sometimes that's no man's land, but sometimes that is there's programs out there that are trying to figure out ways to um, be more efficient with those smaller loans, which are less profitable, but the SBA has also helped out there as well. So those are starting to come online more. We're doing them. We have a separate team that's helping with those small loans, but we'll do them for 100 to 500,000. We just can't handle like anything that involves like construction. So it's got to be pretty simple to fund. So like a business acquisition, for example, or working capital, growth capital. Um, and the lines of credit are another product of the SBA. And those are sometimes a business needs a line of credit. And when you're buying a business, your only chance of getting one in the first year or two is that SBA lender tacking it on. So we'll consider those as well. There's two products. There's a cap line and express line of credit. The express line of credit is 50% guarantee. So it's, there's more risk to it. The cap lines are a little clunkier, but there's a 75% guarantee. The article that came out that I don't know if you're referencing is that the SBA is now looking at introducing a new line of credit product that combines the best of both of those, because both of those products are not very popular for lenders to offer.
Yeah.
And they want those businesses to have those lines of credit. So we'll see what they come up with. There's more details that we're waiting for.
Okay. Um, a question has actually come in from Rajiv. He says, what are the best ways for folks not resident in the US to be able to apply for SBA loans? So, yeah, can anyone outside the US access this?
You could be an equity partner of a business that gets an SBA loan, but the business itself, to be eligible for SBA, has to be 51% owned and controlled by a US citizen or legal permanent resident, so a green card holder.
Okay. And Tony says, does the SBA review my credit score?
So that's a trick question, because it's a common misconception that I want to address. The SBA isn't reviewing these files. So if you're a preferred lender like us, then we're going to do everything in-house, process, underwrite, close in-house. So the question actually is, are you, me, Ray, and TrueLiant, are
Mm,
you guys going to look at my personal credit? And the answer is yes, because we're lending to businesses, yes, but we're also, it's, who owns the business. These are typically small businesses owned by a person or a couple people. And if you're one of those 20% or more owners and you're personally guaranteeing, yeah, we're going to look at your credit history and just see if you have a track record of paying your bills on time or if you don't. And that's going to definitely play into the equation.
Is there like a score where it's just not even worth someone going for it?
I would say don't call me if it's under 600. But if you're in that 6 to 700, that's kind of like this is for like a FICO score or whatever. If you're in that 6 to 700, it just depends on what's going on and what kind of deal it is. I've done stuff where it's 600. That's like the lowest I've gone. But, are we fully secured with collateral? And what's the story behind that? Like, is it in that case, I'm thinking of it was a collateralized deal and the owner had some medical issues a couple years back and there were some things they were working out. And, it was just a really one of those stories where it's like, oh, it's just like, it's not your fault, really, is what it is. Now,
Yeah.
if you just like to miss a couple payments every year, and that's just how it's been, that's a little tougher, Isolated incidents with a good story, and yeah, your score is now 650 as a result. Like a lender can, like, we'll look into that. We'll hear the story and then make a decision of, because at the end of the day, it's like we're just trying to figure out, are you a person of good character?
Mhm.
And that's what it comes down to, not necessarily the score.
Okay, yeah, that makes sense. Last year, actually, my credit score went right down. I went to get a car, and they said, did you know you've got CCJ against your name on your credit file? I was like, I don't think you have. I think you're looking at somebody else's record. And they went, no, it's definitely you. I'd moved house 3 years ago and I had a parking ticket and it had kept going to my old house. And eventually I got this default on my score. I had to go to court and have it expunged, but thankfully they did take it away. It's not on the record anywhere now. It's really funny, but it proves how things can happen without any knowledge.
And if you're a small business, chances are something has happened that was adverse and you have to deal with that. And I like to be sympathetic to those things where if you're trying to do the right thing, but like, it sometimes stuff is out of your control. So I totally get that. I mean, there was one I looked at the other day. It was the lowest credit score I've ever seen. And they started the process with me at a 700 and we were doing it was a restaurant bar acquisition and the manager was buying the business. And we love these types of transactions where the manager buys the business because the manager knows the business inside and out. Now, if you're
Mm.
managing a bar, it's a little bit different environment, right? Those types of buyers are they're they're not finance people. They're not maybe not credit people. So this slipped the radar, unfortunately, and they didn't maybe realize that this is going to be a really big deal. And what happened was since they worked out some sort of deal where the seller stopped paying the manager during this transition and was going to count it as the equity or something like that. But because she lost her income, she stopped paying all her bills. So all of her obligations became 90 days late by the time we actually pulled the credit and the score was 440. And now we're like, okay, this deal just died. Like a horrible, bloody death.
Wow.
Unfortunately, totally avoidable because we were going to do that deal. But I mean, if if you don't know now, you know. I mean, for sure, personal credit is going to be looked at.
Yeah. Wow. Powerful story. Um, what type of businesses will the SBA not fund?
Yeah, so there's definitely some businesses that they won't lend to. There's actually a list somewhere on their website. It's kind of random stuff. I mean, you got to remember it's a government program, federal government, so they don't like anything where it's discriminatory in the hiring practices. Hooters is a famous example of that. Um, they don't like gambling. So if the majority of your revenue is coming from gambling, that is a problem. Um, Gentlemen's clubs are a no-go.
Hmm.
Um, Marijuana businesses, since it's still illegal on a federal level, that's a no. Speculative businesses, this is the last one I'll say. That's a no. That would be like your real estate developer could be a speculative business. We're going to build this home and hope we sell it for a lot of money. That's speculation. Anything with currencies too. So crypto, I'm pretty sure crypto is a no-go. But anyway, it's like a bunch of random stuff. But for the most part, 99% of privately owned for-profit businesses are eligible. Nonprofits are not eligible.
Okay. Yeah, that's really interesting. And I guess just going slightly off topic, when CBDCs come in, will their opinion on cryptocurrencies change?
What are CBCDs?
Central bank digital currencies, so the US uh, digital dollar.
So they don't get involved in any currencies. So if your business is, I forget the exact verbiage, but maybe currency trading. Um, if you're, I think they're going to have to address it at some point. Like if you're, like I have gotten a call about a crypto mining operation. You know, um, I doubt they're ever going to get into anything like that. But it's not really. I don't think it's been officially addressed from them head on.
It'd be really interesting if fiat currency has disappeared and we have a digital currency, that they still say they won't invest in a digital currency.
But now we're in the metaverse. I don't know. I'm lost.
Yeah. That would be funny. Um, how long? One final question, because I think we've got you've got another call afterwards. But one final question: how long does it take? So let's say I come to you and I'm like, I found this amazing business. It's right in my lane. I understand it. I'm okay at finance as well. How long is it going to take for the SBA to pay out?
So it's really it's the number one question, right? It's the question I answer every single day, and it does take a little bit of a nuanced answer because it depends on where you are in the process of buying a business. Because the quickest one I've done was about 6.5 weeks. Start from the time you called me to the time we're at the closing table. They already had a fully executed purchase agreement. They had already done a quality of earnings report. They had they were so late in the game and the deal had fell through at another bank. So we had to pick it up and run. It's not super typical. Most people are coming to us around at the time they're signing an LOI. When you're signing an LOI, I always say like just try to get 90 days in there and
Mhm.
let's shoot for 60 because it is very possible to go through that process to say I'm going to spend the next 30 days going through my due diligence with the seller. While I'm doing that, I'm going to package my loan up and get it into underwriting. While we're doing that, we're going to order a business valuation. Okay, now you've done all that stuff. You're 30 days in. What's the back half look like? Okay, now we're going to go back and forth on an execute on a APA or stock purchase agreement. There's usually 2 to 3 weeks of that. While we're doing that, we're collecting all the SBA closing documentation. While we're doing that, we're doing some due diligence on the back end, ordering searches on the seller and the buyer and all like that. Once all those closing pieces come together, we do an internal audit, we prepare the closing documents, and we close. That little part at the end takes about a week. So that's kind of like an ideal process going out 60 days there. However, what often happens, which stretches that to 75 and 90, is that curveball that's going to get thrown at you at least once somewhere in that 60-day process. And that can pause things for a couple of days or a couple of weeks, depending on what it is. Totally normal. You should expect that. But that's why it's like you got to get the right deal team around you because you got to know how to deal with those curveballs. I've done over 100 transactions since 2021 and I've seen a lot of different things come, and just this week I have multiple things come, and it's just like one of those things where the more reps you get in, the more experience you get, and you can then leverage your lender's experience to try to help be more proactive in those situations and ideally avoid the issue uh, completely in the first place.
Yeah, that's a good point because there's usually a curveball at some point in the process.
Yeah. Yeah. I don't see many that go perfectly smooth. Maybe
Yeah.
never. I'm pretty sure that's never happened.
Wh- we've talked about a lot of things. What the SBA is, how to access it, what they can and can't do. If people are watching this and they're like, I need to speak to Ray, he's the man that's going to help me with my acquisition or whatever type of lending, how do they get in contact with you?
Yeah. So I work at TrueLiant, SBA lending. I'll give you that email, but the other one's probably easier to say, which is ray@artofsba.com. But my other email is ray.drew@trueliantfcu.org. So if you want to just find me, just probably Google Ray Drew SBA and I'm going to show up. I'm on LinkedIn. And also I've got a YouTube channel that's separate from my podcast that has like a ton of really good information on buying a business and using SBA debt. And that's just SBA Ray. So I know I just gave you a lot there. You can link to whatever you want. I'm not hard to find.
Fantastic, thanks. We'll make sure we put all of this when it goes out as well. Just someone just sent a last question in, if that's okay,
Sure.
saying they've seen you talk about the silver tsunami and the fact perhaps it's overrated. So have you got any thoughts on that?
Ooh, ending with a little controversy. Yeah. So it's the Kool-Aid, man. I was drinking that Kool-Aid and I was talking about this silver tsunami. And then one day the somebody posted the data um, for the amount of change of ownership transactions, business acquisitions that were financed by the SBA over the last 5 years. So going back before silver tsunami was ever said to the last year and looking at it, and it's flat. So it's like how do I reconcile that? There's no growth in this SBA business acquisition space. So I would have thought that there was at least a little bit of an uptick. There's actually a little bit of a downtick in business acquisition loans last year. So I'm like, to me, I think the big difference is it's a it's a buyer tsunami. I think the idea of buying a business has become so widespread. It's so intoxicating. It's like these multiples. I work for myself and you now can see that because Buy Then Build came out in 2019, famous book on the topic written by Walker Dybel, podcasts all over the place on this topic, and social media, Twitter, X. I mean, we have a big community there. And so the idea of this, and then also the colleges teach search funds and self-funded searches have become like super popular. So all of a sudden, you have all these buyers. And so the reason I thought it was so real is because my phone was blown up 10 times as much, you know, but at the end of the day, I'm still doing the same amount of transactions. So I think there is a little bit of a disconnect there. I think the idea makes sense. Baby boomers have businesses. They have to retire. They have to sell those businesses. I don't know how many of them are quality businesses or businesses anyone's going to want to buy. Maybe that's the disconnect. But
Hmm.
the fact of the matter is, SBA business acquisition lending remains flat.
That's really interesting because you do hear it all over the place, don't you? There's silver tsunami, everything's going crazy. There's a huge wealth transfer happening, and you've got to get part of it. Uh, really interesting. Is there anything that you would like to share that we haven't covered?
Not really. I mean, I like talking about SBA. I like talking about business. I started my own business. I have a media company with, podcasts. I like to stay busy. So yeah, I do SBA lending. I do content. I have my side businesses. I'm just like, I think that's why I just like doing what I do, because the people coming to me that need the financing, like I think like them. Like I'm not trying to just you know, work a W-2 job and, save my 401k and, retire at the end of the day. Like, let's build something. Let's build a community. Let's build businesses. Let's network. I love it, man. So I'm thankful to be here and I appreciate you having me on.
Oh, fantastic. That's great. Great to hear. And thank you so much. I've really enjoyed it as well. Let's keep in touch and maybe do another one of these in the future.
Sounds good, man. Thank you so much.
Take care. Bye bye.